Alright, hello YouTube. This is going to be a video in the Everyday Investor series. And in this video, I'm going to talk about how you really need to start saving early if you want to retire comfortably in old age. I was, on the weekend, I was with a friend, and my wife mentioned that I'm saving for retirement and I want to have at least 100 grand a year to live on in my retirement till I'm dead. And that's just me from what I'm saving. And he kind of looked at me weird, and he's like, are you actually on track to do that? And I'm like, yeah, of course I am. And you got to remember, I'm 37. I've got 28 years left if I want to work right till I'm 65. And he's the same age as me, and it kind of made me think that it's not normal for my generation, or at least my group of friends, to put any thought into their retirement or to plan it out to figure out how much they're actually going to have. Because a lot of people put money in through work, but they see that money there, but they don't know. They don't look ahead and do the calculations and find out what that might be actually when they go to retire. So I'm going to kind of get into that here and how I'm kind of doing. The last week, the stock market hasn't really done anything. It's kind of all moving sideways. Katanga, well, we gotta go a little shorter here. Katanga's just moving sideways, kind of on a slight downtrend. ACB, same thing, sideways, slight downtrend. Volumes have been really small on all of these. Afria, slight uptrend, but kind of everything's moving sideways. The only thing that's really doing good is this REIT, which just started skyrocketing. I think that's because that company's kicking ass. They're moving into Belgium and with properties, and I think they're trying to acquire another property. And their Q2 financials came out, and they're kicking butt. And they've got a nice, healthy, what is it, 7.65% dividend. So just to kind of give that into perspective, say at 1090, if you were to pop in about 14 grand of stock into this company, they would pay you close to $1,000 in dividends a year, free money. So this is the REIT that I really like, because I've been following it now since December, and they're kicking butt. They're doing good. But anyways, let's get into the retirement thing. So as I think I've said in a previous video, I've been through work, I've been getting money put into pension plan and investment plan. And this is my 2013 tab. Everyone should track all of their finances. I recommend doing it on spreadsheets, assets, debts, net worth, yada, yada, yada. But as you can see, 2013, so I didn't have a whole lot of money from work, so you can see I made about, I don't know, a 1% return on my investments in 2013. In 2014 here, I took a huge loss because I was dumb, and I pulled out a whole bunch of money and bought a motorcycle because I had just gone through a divorce. Separation, actually. I ended up getting back with my wife. But anyway, big loss here. This year really hurt, but I wasn't really caring. I just thought I had lots of time, and my work was putting enough money in a way that I could retire. Pension plan means you can retire comfortably. Not necessarily. 2015, didn't touch any of my investments, and I only made about a 2% return this year, but that return equaled, after investments, $865 profit. 2016 was a good year. Unfortunately, I did take out some money in July to go on a holiday, but even after that, I still made a 6% return on my investments in 2016, which equated to $3,200. So this year is really crappy, and this is 2017. This is the year that I've been investing by myself. So if and I always track these numbers to the end of the year. So by the end of the year, at least in my pension plan, I'll have made 4%, which is fine. My investment plan, due to the Sonova stock nosediving, huge loss of 6 grand. over, and that's after what I've put into it. And my holdings account, if I just put in my $300 a month and nothing changes, I'll make a whopping $5 on the year, or 0.1% yearly return on my do-it-yourself investments. That I plan to change, though. That will change. Trust me. So for the year, I'm probably going to lose about $4,000. And I think I did the calculation, and after my work's paid into my pension investments and I've put into investments, I will have put away about $19,000 into investments for my retirement. And that sounds like a lot, but it's really not. So we'll briefly go through 2018, 2021, and I track all my numbers. I do estimates to basically give me a 4% return every year. I think 4% is doable. This is if nothing changes, if I keep getting paid at work what I'm getting paid, if I put in $300 a month into my investment plan, I should easily make 4% return a year on everything. And it's doable. Like 2017, I'll make 4% on my pension plan. 2016, like I said, I made 6%. It's doable. So if somebody puts upwards of $20,000 in investments away every year, which sounds like a lot of money, and I'm 37, and if that trend continues until 2045, then by 2045, given no changes, you know, my company doesn't sell out, it doesn't change, I don't lose my pension, I don't lose my matching investment plan, you know, some big life event doesn't happen. If nothing changes by 2045, when I'm 65, I'll have, what is that, about $1.2 million in those three accounts: my pension plan, my Sun Life investment plan, and my holding account. So at that point, I'll probably, my pension plan kind of stay, you know, it's pension plan, and my Sun Life account I'm gonna roll over in my holding account. So then here's the retirement plan, retirement years, and this is going down to 2065 when I'm 85. So my plan is to draw $100,000 a year out of my pension until it's dry. So that will take a whopping, what is that, 9 years, and then my pension account is done from 500,000 to zero. 9 years. And then after that point, I'm going to move to my investment account and pull $100,000 out a year. And if I die when I'm 85 and my wife dies when I'm 85, there could possibly still be $500,000. So really, I could probably adjust these numbers, but to be more. But do I need more? I don't know. Hopefully my house is paid off, and that gives us enough to travel and live comfortably. So 100,000 plus about whatever it is in Canada, 12,000 a year for CPP. So if we still have CPP then. And then the leftover money, and as you can see here, I think this calculation takes into account, yes it does, this calculation takes into account, so it takes 63,000 out of my pension account, and then it takes the CPP and the possible dividends, because hopefully I get 4% or have a 4% return as dividends every year on my investment account. So this $100,000 comes from, as you can see up here, 63 grand from my pension account plus my dividends and the CPP. And that's what I'll draw. That's the plan, to draw from until I'm dead. So I should retire not broke. And there you go. That's kind of a guideline. If you're my age, you're going to have to start putting away 20 grand a year to only have over 100 grand a year in retirement savings. If you're doing half that, I don't know, maybe you'll only have enough to survive. You'll have 50 grand a year to survive on. And that depends on what your money's getting put into. So I guess the bottom line is save early. When you get into your 30s, there is no more time to put it bluntly, there's no more time to fuck around. You got to start worrying about your pension now. And I'm sure, given, this is 20 some years, there's going to be some changes to this. I'm going to have to readjust this. I might have to go contract with work, and I might have to put all that money in myself. So my investment account could be closed, and I'll roll that into my holding account. But if say my company goes under or sells, they might not match the 5% of my salary every year. Who knows what they'll do? So really consider how you want to retire and know what it's going to take to get there. Because I started late, and I can still do it. So can you. Anyways, if you have any questions, comment below, and I will get back to you. Peace.